Welcome to the Jack and Bill Show. We are live. I say we. I've got Mr. Wesley Roderick here in place of Jack, who is out today. Welcome, Wesley.
Why are you so close to the microphone?
Should I back away?
Well, I mean, you crept up to it like you were trying to sneak up on an animal outside, like you're in Times Square Park. Like you're in Central Park trying to sneak up on a squirrel.
Well, that was my nickname in high school, Sneaky.
Oh, I thought it was squirrel.
Oh, okay.
Anyhow, we're here.
Dare I say it's Friday the 13th.
Dun, dun, dun. We don't use sound effects here because why? But we are here. If you are watching or you end up catching the replay, let me state up front, this is an audio version only. You do see a picture. There's a very nice office. That is not Bill's office. But if you are watching, let us know. Say hi. Drop us a comment. Drop us a question in the comments. And let us know how you're doing. We want to hear from you.
I have the first question, Wesley.
Do you have a live caller?
The question is, why do you sound like a sick dog?
Because I've been fishing this whole time, and now I have fisherman's friend. Allergies.
Uh-huh.
These California lungs, these delicate lungs, are not meant for the South.
I get it.
So
you are a fish out of water.
I think here the appropriate term is I'm an alligator out of the bayou.
That too.
And so this is going to be about 20 to 30 minutes of seeing if William can stay up to speed with me.
Oh, okay. I'm up for the challenge, I think.
I think me too.
Far away.
So let's talk about the I mean, it's not really the elephant in the room in this case. It's more of like
the bear in the room.
It's the bear in the room, actually, when you think about it. The bear in the room right now, everything's going down.
It seems that way.
Like this is going down quicker than Titanic. Now the question is do we become like the musicians, the band of Titanic, and we play until that ship finishes sinking? Or do we become like the elite of the Titanic and start pushing women and children aside and fighting for our own salvation?
Wow.
Do we abandon ship right now? I mean, that was quite the analogy. But do we abandon ship right now and forsake and just cut our losses, jump out of the boat, like, whatever stock didn't make us the money. AMC did not hold its value. Who would have thought? We never said anything like that.
No, never.
Or do we ride the wave?
Well, how about this? You presented us with false choices. Perhaps we don't need to go down with the ship. Neither do we need to jump ship.
Are you saying the iceberg was fake news?
Perhaps the iceberg was worse than it seemed. Here's the thing about investing. It often seems worse than it is when you are in the midst of a market correction. And it can be very difficult to see through this and how possibly the markets can recover. This is very common. It just goes back to our human psychology. And we are limited in how we perceive things because we're perceiving things with our brains. And that is a limiting factor in all of this. Human nature dictates that we're governed by fear and greed. And right now, people are very fearful.
Because the greed need isn't being met, or what are they afraid of?
Well, let's throw out some actual numbers. Through yesterday, the S&P 500 index, which is the most commonly referenced stock index, was down 17% year to date. The Bloomberg Barclays Aggregate Bond Index, the most commonly cited bond index, was down 10% year to date.
I just want a question. Who's really citing that? That's a long name.
Well, there's a long explanation for why it's such a long name.
I'm surprised it doesn't have an acronym.
Exactly.
Who's really citing that information. Like they're going, it's the Berkeley blah 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 Bloomberg ladder whatever bond index of North America.
All right. Don't focus on that.
Well, you said it's regularly cited. I just want to know who's saying a sentence before they cite anything.
All right. Well, I'm going to use these two lengthy indexes as benchmarks or as proxies and say the proxy for the U.S. stock market was down 17% year to date through yesterday. The proxy for the high quality bond market was down 10% through yesterday. Those are big declines in a short period of time. And it's totally understandable for people to be unnerved by that. Totally. And it here's the fallacy is you can look at your account statement and quantify in dollar terms how much you're down. And you could say, I've lost X amount of dollars. Well, my first answer to that is, have you really lost X amount of dollars? You're only losing money if you actually sell the investments.
Right.
And people will commonly measure their losses from the top, not from their cost basis. So we've seen the markets have a tremendous run here, and people are measuring declines from all-time highs.
Sure.
Do you see the fallacy in that?
Well, I mean, when you're measuring, when it'd be like if you bought a car right now. You're paying top premium dollar for said car.
True.
And let's say through some form of Marvel Universe, Doctor Strange magic, everything gets flipped around and restored back to what it was, say, hypothetically, in 2018, 2019. Did you just lose all that value in the car? Bill, they can't hear you when you shake your hand.
Good point.
You lost the value in the thing that you paid the premium dollar for.
Correct.
Not necessarily what the car was worth. It was only worth this much at that time. And so I guess in a sense, what we're losing is the premium value, not necessarily the actual value.
We can say with confidence that, broadly speaking, the U.S. stock and bond markets got priced too high. What we don't know when we're in the midst of that excessive price environment is when it will end. We never know when something's going to end like that. We can recognize when things are overpriced, but we've learned from experience that investments can stay overpriced for much longer than we believe. And the momentum will just carry it higher for longer. So you want to be aware of overvaluation conditions, but trying to time when the top will occur is impossible.
Now in the South, you have a little bit more of a statement like this. When somebody gets a little too arrogant for the reason they could be arrogant for, they got a little too big for their britches.
Yeah,
I agree. What you're saying is some of these things got a little too much exposure, a little too much hype, too much attention, and they got too big for their britches.
Let's cite some specific examples. And here's where a correction can be very healthy. When we see speculative excesses, and specifically, we definitely have seen that in areas such as cryptos, non-fungible tokens, meme stocks, special purpose acquisition companies, and on, where we were seeing things that were driven entirely by speculation. And now we're seeing washouts in those things. That's healthy. We need that.
Now, I'm going to play the millennial devil's advocate on this.
Of course you are.
Those are all things that, on a regular basis, I would say, from my perspective, are not your most favorite things.
Fair enough.
These are a list of some of my favorite now. But with that in mind, what are some examples that are not in those categories? Things that got priced too high that aren't considered meme stocks.
Sure.
That aren't social media driven, social media influencer influenced.
Okay. So I was citing extreme cases, extreme examples of speculative excess. If you want to think about like a continuum of risk or a spectrum of risk, and let's say that what I just cited, those examples are one end of the extreme. And if we move away from that extreme end, the next thing, okay, let's say,
let's take Ford. What height does Ford? No one's tweeting about Ford.
Oh, you had to go there.
Oh, yes, I did.
Oh, really? Okay, well, we'll get to Ford. But before, let me finish my thought process here. What about companies that aren't generating earnings?
Yeah.
Okay. It's an idea. It could be a great product, and the company is very young in its life cycle, and so they're not at a point yet where they're generating earnings. Um, they're unprofitable. Okay, in a market climate like this, those companies are at risk, and companies that are not generating earnings, yes, they're going to get hurt in this kind of climate. Let's go down further. Let's take mega cap tech names. All right, some of the names like Facebook, Amazon, Netflix. Okay, these are high quality companies. Would you agree?
I feel like quality is really a perspective term.
All right, let's just say for discussion purposes.
Yes.
Okay, well established, good products, services. Um, they're not going anywhere. You're not worried about them failing.
Well, you might be now.
Probably not, but
I mean, Netflix.
But people bid these stocks up too high.
Right.
So they were paying higher multiples for these names than they have in the past. So people were willing to pay higher prices for the future stream of earnings from these companies. So when we see a market correction, we see a resetting of prices. So the multiples will contract. These things are still in demand. People still want to buy shares in these companies, but they're just not willing to pay as much for the same stream of earnings.
Yeah.
Does that make sense?
I mean, it makes sense. I mean, I think a lot, I mean, we've had this conversation. I think a lot of things are getting also affected by where you have people are returning back to life. But then there's things that are interesting. Let's take, because people are returning back to life now, where we were at during the height of COVID, and this is just one instance I can think of off the top of my head, is we had maybe one functioning Starbucks in all of Shreveport during COVID. Even during social distancing, all that. Here we are opening back up in 2022. Things are changing on a nationwide. But yet still Starbucks is down 30, 35, almost
more than that.
They're down 35% year to date. I'm looking at it right now. They're down 35% year to date.
Mm-hmm.
But yet, shouldn't their earnings be going back up right now? They're now opening they've probably closed down a bunch of stores and now opening some of the busier, more popular ones. So I mean, it kind of, where is some of this? I mean, I know one of the biggest issues I think that every industry is running into is finding workers.
Oh, absolutely.
So that's affecting things.
The cost structure is changing for businesses, and so if we just look at it in simple terms, you have your top line revenues, and you have your expenses.
Yeah.
And you subtract your expenses from your revenues to get to your earnings.
That's true.
So expenses are going up because of inflation. So input costs, things that these businesses have to buy in order to produce their goods and services, are higher. and the cost of labor is going higher. So businesses are having to pay higher wages to attract employees. So that cost structure has changed. And thus far, businesses have been absorbing a lot of that, and that is affecting the bottom line. As long as they're not passing along those costs to the consumer, that means lower earnings.
It has put us in an interesting predicament.
It really has. But this environment that we're in right now is unusual because we have grown accustomed to an environment where the Federal Reserve Bank, the Fed, has been very accommodative in easy money policy. And this goes back to the credit crisis when the Federal Reserve Bank slashed short-term interest rates to zero and began their quantitative easing bond buying program. And so I think everyone has just been lulled into complacency, believing that the Fed's got our back. And with easy money, low interest rates, why not speculate in investments? It's worked. It has worked. Well, what has changed? What's changed is that now we're facing inflation. We have not had to deal with inflation like this for a long time. And this is now challenging the Federal Reserve. The Fed has to act, and they're doing it by raising short-term interest rates. And they've also announced curtailing of bond buying in their quantitative easing program. So interest rates are going up, and when interest rates go up, bond prices go down. So the bond market is suffering. With interest rates going up because of inflation, the stock market is suffering. So this is a unique climate that we're in because we're seeing stocks and bonds correlate together to the downside. So they're both going down. And in years past, when we've seen the stock market correct, we've seen a flight to quality into high quality bonds. So bonds have been a safe haven. Thus far this year, they have not.
So, is there any safety?
Well, safety, is a relative. Try another fisherman's friend, my friend. Safety is relative. And there are some things that provide levels of absolute safety. Okay, let's look at cash. All right. Everyone has said in the past that cash is trash. Well, cash may be trash because of the opportunity cost. You're missing out on higher returns in other things. You could also say cash is trash because of the rate of inflation. So your buying power on that cash is diminished because of inflation. Well, if you started off the year fully invested in cash, you'd be better off than if you were fully invested in stocks down 17% on a nominal basis. So would you rather be earning zero on a nominal basis or have minus 17% on a nominal basis? I'd take the zero, right? Hindsight's 2020. So cash.
So you can get 20% on hindsight?
Something like that. So cash, you could say, is a nominal safe haven. It won't help you preserve purchasing power, but it is a nominal safe haven. Precious metals, can be looked to as safe havens, and precious metals tend to have a decent track record in a rising inflationary environment. But we've been seeing precious metals under pressure here lately as the U.S. dollar has been increasing.
Is Bitcoin a precious metal? I kid.
But to get back to your question, for people who have a long-term investment horizon and have an investment goal in mind that requires them to put money to work in something other than cash, then yes, those people don't need to be moved by what's going on in the markets. They need to maintain their perspective, continue in a disciplined manner to be invested. But as the saying goes, there's always some place to make money. And there are areas in the market where these investment products are making positive returns. And I'll mention specifically managed futures. Okay, that's an alternative investment. Managed futures, broadly speaking, are doing terrifically well in this environment. And there are reasons for that. Energy, okay, the energy sector, specifically energy stocks, have done really well this year. So
we've paid a lot for it. I assume when you're speaking of like energy stocks, I think of like things around oil and gas. And we're paying a lot for it. I hope it's doing well.
Oh, I see what you're saying. Yeah, we're paying for it at the pump. Gosh, I mean, we could spend a whole show talking about the energy sector, but that is an area that has been hurt by underinvestment. That whole sector has been underinvested in for many years. And now, as a result of underinvestment and a spike in demand for energy products, you're seeing the common stocks of these companies really take off.
I think here's the real question, William.
What is the real question, Wesley?
In a conversation I was having with this day and age of audience, people that are probably roughly below 50, but they're still adults. This is the time frame where they're starting to think about, if you're between 25, maybe, which might be on the young end unless you grew up with a certain mindset, you're just now thinking, if I want to retire, maybe I should look at life differently. But people around my age in their, late 30s, mid 30s, maybe even early 30s, our understanding of recession is definitive by the housing market because that's what we remember. One, maybe you can elaborate and help explain some things, is that part of what necessarily defines a recession? Because some people think we're in a recession. Some people think one's coming. And then secondly, are we in one or is one coming? Go.
Well, okay. Well, first.
That's great. Thank you, sir.
Well, let's see. You threw out a lot of things there. One, all right, let's go back to the first thing you said, and it has to do with our frame of reference. So the younger you are, the more limited your frame of reference.
Right.
For someone who's been investing for the last 10, 12 years, all that person has known is a bull market, a strong bull market with very few corrections.
Yeah.
Let's take it back a little further.
They've actually probably experienced more of social media cancelings for certain stocks.
Well, that's true.
Than they've actually experienced corrections.
That is very true. But, you take it back a little further. Now you encompass the credit crisis. And during that time frame, we saw the U.S. stock market correct by more than 50% in a short period of time. That was very painful.
Oh, yeah.
And during that same time, we had the housing bubble bursting. So that correction in the market was really driven by real estate housing and the huge speculative excesses in the housing market. Now let's take it back even further to the tech bubble. Okay.
Yeah.
In the late 1990s. All right. That was driven by speculative investing in technology companies and .coms and all of that. For someone who started investing just prior to the tech bubble bursting, they got walloped in the tech bubble. They saw their investment assets decline sharply. And if they were heavily invested in the .com junky stuff, they could have seen 70, 80%, 90% losses on individual names. Then they see some recovery, and then next thing, it's a subprime mortgage crisis and credit crisis. So they get walloped again. That's a lot to stomach in a short period of time. And for those people, especially those people who were closer to retirement, they could have been washed out.
It's a lot of walloping.
A lot of walloping, and they may have been of the mindset, I'm not doing this again.
Right.
I've been burned once, been burned twice. I'm not going to get burned again. And it's a shame. But it's always important to try to increase our perspective by looking further back in history. Let's take it back to the 70s, because there is talk now about the risk of stagflation. And stagflation is a condition where you have an economic recession, right? A slowing economy, and at the same time, you're dealing with inflation, rising prices. That's a tough environment to be in. Well, we experienced that in the 1970s, and the inflation was being driven by energy price spikes. So we had a muddle through economy, and we had inflation price spike. So people were waiting in lines to buy gasoline. It was a terrible environment. But we want to go back in time to study history so we have a better understanding of what may be happening today and what are the possible risks going forward. Are we in a recession right now? Academically, no. Okay, we measure that. We measure that in terms of GDP declines, but we're not there. We never know until after the fact, and so the government entity that's tasked with defining recessionary periods, they have to do a look back. It feels, I don't know, it's difficult to really kind of understand, because we have these cross currents. On one hand, we see things that look recessionary. On the other hand, we have the economy that's reopening after the COVID lockdowns. So it can be really tricky to understand where we're at right now.
Yeah.
So there are pockets of the economy that are more cyclical in nature that are really just getting their feet back. I mean, look at like movie theaters and amusement parks and things like that. They're just reopening. But then we can also look at other things where we can see that there are some indications of slowdown.
Yeah. So the 70s, what was that like?
Disco music, it was awful.
Now that's like the 70s. That's when you started your first company, right?
That's when I was a kid with long brown hair and bell-bottom jeans.
Huh. Well, you heard it first here, ladies and gentlemen.
Absolutely.
Bill had hair.
Yes, I did have hair.
I've seen the photos.
I liked it too.
I've seen the videos.
I've had a lot of conversations recently with clients, and one we've just recently completed a quarter, and we always make a point, to try to update people, on what's happened at the end of the quarter, but also because of what's been happening in the markets. It's just nice to reach out and communicate and reassure people. And something that comes to mind is that, that famous quote, things are never as bad as they seem, nor are they as good as they seem. And, when we're in the midst of a toppy market, it seems like it will never end. And it's difficult to see what could cause the good times to end. And when we're in the midst of a correction, it may seem like it can only go down from here.
Well, here in Louisiana, we don't talk about good times ending. We say let the good times roll.
That's a very good point. We should all be so fortunate as to live in Louisiana.
Well, it is the sportsman paradise.
Absolutely.
So, all right, we've been doing this now for approximately some time, 20 minutes or so. I don't know how long.
Too long.
But all right, so here's what we would call a hot take. A hot take, it's like a bill. Remember when we were doing the billions, the Bill's opinion?
Oh yeah.
We used to do this thing on TikTok. By used, I mean we started it and then we never did one after the fifth one. But what would you tell a sophisticated investor for the next 30 seconds of how they should be responding to this market? Sophisticated. So that means use all that terminology that I'm like, we should stop using that. This is the time to use that. Next 30 seconds. What would you tell that sophisticated investor?
I would tell the sophisticated investor much the same as I would tell a non-sophisticated investor. Stay focused. Just stay focused. Consider your investment time horizon. Remember why you're investing in the first place. Don't be shaken out. Turn off the news. There's so much noise out there right now. And the more we listen to the noise, the more fearful we get. And that's just simple advice
That's
to offer
life advice
anyone.
right there.
That's life advice. Yeah, and the quote I said earlier, things are not as bad as they seem. The markets in academics, they teach market efficiency, and that has to do with how quickly markets process all available information. Well, what is a market? A market is just it's the market participants, right? Whether it's a fish market or a grocery market or a stock market or a bond market, it's people.
Yeah.
Well, when it comes to financial markets, information travels so fast. When you read something in the news, it's old news. You like to say that to me and Jack in the office when we're reading the Wall Street Journal.
Yeah, you're reading last week's information.
At least last night's news. At least.
Maybe if you're lucky.
Maybe.
If it made it into the printing press, beforehand,
Exactly.
And they had to stamp out the individual letters.
And then it takes a day longer than it should to get delivered to your doorstep. That's another story.
That's more of where we're located, not less than Wall Street.
True. So it's old news. So you have to assume market participants are already aware of this, and market prices should already reflect a lot of this information. Now, again, this is academic. It's not scientific. And in reality, we know that markets are not fully efficient. They're pretty dang efficient, though. Why am I saying all this? There's a lot of bad news that the markets have had to factor in. We've had to factor in rising inflation and inflation expectations for some time now. We have had to factor in war in Ukraine, COVID. We've had to factor in supply chain disruptions and all this stuff. The markets have priced in a lot of negative news. Market prices have responded. And I still have faith that we can get through this. And as long as the earnings are still there and analyst earnings expectations are still strong, that these markets can process through this. The big question mark is recession risk. If the economy in the U.S. enters into recession, and I don't see that as a 2022 risk, this is just Bill speaking, but let's say that the economy goes into recession within the next couple of years. Well, that's a possibility. And I believe that the markets fully understand what would likely cause that. The known, I'm going to say known, getting back to the concept of market efficiency, The known cause for why we're going to go into recession, if we go into recession, will be the Federal Reserve Bank itself. So the Fed has a strong track record of overshooting, going too far too fast with monetary policy. They most recently they held interest rates at zero for way too long, leading us into an inflationary environment. Now they're having to battle inflation, and the risk is that they take interest rates too high too fast, pushing the economy into recession. Everyone knows that. So as the Fed progresses through this year and continues to raise the Fed funds rate as they're battling inflation, markets should not be upset about this because it's known. Does that make sense?
I think the constant moving variable in that is people.
Oh, absolutely.
Which is your unpredictable. I mean, to a degree, it's predictable, but to another degree, it's completely unpredictable.
That's the problem with markets. People.
Well, that's the thing is like oftentimes we'll use terminology. The market knows this. And we've had that conversation a number of times. Even recently about other certain organizations where it was clear that the market didn't know that because they didn't respond accordingly to the news because they didn't know how it was going to affect that company financially. But so even though we could say the market will respond accordingly, that still is kind of the maverick in your flight school.
Well, it
I like to
is.
go for the top
It is.
profits.
And to your point, if markets are fully efficient and investors, market participants are, hold your seats, rational, then we would never have bubbles.
That's true. We actually have a question.
Yeah.
From a live watcher.
Excellent.
Paxton.
Yeah. Hey, Paxton.
Given supply chain issues and all of the relief funds, did you see inflation getting to the point it is at today? If I could maybe let me say something here. The as it is today, are we talking about as what it's being projected versus are we saying what it's being said through news channels or the actuality and the feeling that we're actually having in certain places where we're seeing inflation? Because inflation is being projected as like 8 and 9%,
yeah,
while we're seeing 30% in most places.
Well, let's not get conspiratorial. Let's use government numbers. All right. Over 8% on the CPI. No, I did not expect that we would get as high as we are on the CPI last year, even in the midst of supply chain disruptions. The guidance that we were given by the Federal Reserve at that time was that this was transitory. And when you're looking at supply-driven inflation, it's safe to assume that there's a transitory factor there because, we're talking about, transportation issues, and eventually those work themselves out. In this case, the supply chain disruptions, have persisted for longer, than people assume they would. And now with these major lockdowns in China, that to me says that supply chain disruptions will likely persist for longer. But the number, this high number, no, I did not anticipate it getting this high.
Yeah.
No, not at all.
So that answers the question. No, I mean, and not even trying to go conspiracy, but it's, there's the aspect of where we're told on a regular basis, even, news channels the whole time while we're listening to what's being said by the Fed, that inflation was only at this point, but like we're literally seeing that like the cost of things are much higher than 9%. We're seeing But I also understand that they're not looking at it from like everyday use. They're not looking at it from like the cost of like eggs, all the time.
Yeah. I had a conversation with a client today, and I was trying to explain that there's this inflationary tug of war that's going on. On one hand, we have these long term deflationary effects.
Yeah.
Take demographics, that's a huge one. So, birth rates in developed countries has been steadily declining. That's a deflationary effect.
Yeah.
Technology is constantly improving our quality of life. That's a deflationary effect. And when we look at how technology is replacing human labor, that's deflationary. These are long term effects. Battling that right now are short term inflationary effects. And it's hitting us the hardest with these headline inflationary components like food and energy. And that's the reason why we see food and energy pulled out of inflationary numbers so we can look at a core inflationary numbers to smooth out the inflationary numbers for analytical purposes. But food and energy price inflation is more volatile than other inflationary components. And right now, everyone is really suffering when they buy gasoline, when they buy food. Um, and that's not going to change anytime soon. So that's just adding to the difficulty that we have in this market right now, trying to ascertain what's going on under the surface.
Mm-hmm. And then Paxton says, "Hello, Mr. McCollum."
You can call me Bill. You know that.
Can I?
No, it's Mr. McCollum to you.
I'm just your lovely assistant.
Exactly.
So was anything else?
We've discussed a lot of things. We've covered a lot of ground. No one likes it when the markets are correcting. I'll just, again, restate what I've said earlier. Keep your wits about you. Don't make rash decisions. Don't be moved by your emotions. If you need some help, call someone who can help you, like us here at Eagle Financial. And it may be a case of just looking at what you own, understanding what you own. There may be some things that you own that you just don't need to own right now. In a rising interest rate environment, there are securities that do better than other securities. And that's why we're seeing growth stocks underperform value stocks right here. That's why we're seeing long dated bonds underperforming short dated bonds. That's why we're seeing commodities outperforming. So it may just be a question of making some adjustments to the investment portfolio to better posture it for this investment climate. And we're more than happy to help you with that. I hope this has been helpful. Wesley, thank you for the questions, and this has been a fun exchange.
We do have Paxton. So he goes, this is Paxton again. He goes, the last time we spoke, you had mentioned that we could be moving towards an inverted yield curve. Do you still feel the same way?
At the moment,
I feel like I should leave the room so you two
can it's certainly possible. And predicting the shape of the yield curve is like predicting where the S&P 500 will end the year. It's an impossible prediction, but the yield curve, okay, graphically, the yield curve represents interest rates of bonds of different maturities from short to long term. A normal shaped yield curve is upward shaped. And the reason for that is because you would expect to earn a lower yield on a short-term bond and a higher yield on a long-dated bond. You expect to be compensated for tying up your money for a longer period of time. So that's why the yield curve is upward sloped normally. But there are times when the yield curve will invert, it will flatten out and invert, and that's when short-term rates are higher than long-term rates. Historically, when the yield curve inverts, it is preceding a recession. So we have seen in recent months where we have had yield curve inversions on different sections of the yield curve, not the entire yield curve, but we've seen certain segments of the yield curve invert. I still think that we could see it invert. When, I don't know. But if the Fed continues aggressively hiking short-term rates, well, we know what the short end of the yield curve will do. It will shift up. And if the economy is slowing, then we would expect to see the long end of the curve settling down with long-dated bonds moving up in price and conversely their yields going lower. So it wouldn't take a whole lot for the yield curve to invert.
Well, I think that wraps up the show for today, Bill.
You called it, man.
I think we're done.
I think we're done. This was fun, Wesley.
It was, even though I can barely talk.
You did a good job. Try another fisherman's friend.
I'm out of friends, fisherman. Alrighty. Well, we should be back next week, I'm sure.
Safe investing, everyone.
Make good decisions.